The Reserve Bank of India has hiked the repo rate by 50 basis points in its June policy. This was largely in line with market expectations. However, it has also hiked the inflation estimate for FY23 to 6.7%, a full 100 basis points higher than its earlier estimate. To explain the ramifications of RBI's policy announcement, we have with us Mr. Arvind Chari, Chief Investment Officer, Quantum Advisors. After Governor Shaktikanta Das's comment that a rate hike in June was a no-brainer, a rate hike was a foregone conclusion. But did you expect a 50 basis point hike in the repo rate, or was there an element of surprise there?
Sanjay, if you looked at the range of expectations that the market had, it had anywhere from 25 to 30, 35, 40, 50, 65, 75 basis points. So it was all over the place. Of course, we were expecting it to be 35 basis points. So that part was a bit of like, I think some part of the market would have got surprised with that, that it was a 50. But this RBI is very clear, I think, and I said it last time as well, that the credit should be given to this RBI in terms of they are not following any rule book. They are responding to situations that they think needs a response, and also they are willing to change when situations change, right? So they were very dovish, and I called it needlessly dovish in my post monetary policy note in February. But given what has happened since then, they've actually flipped quite aggressively, and they've changed the priority from growth to inflation. They are now in accommodation. They are not calling it tightening, but this is tightening, and they are willing to take harsh steps. So if you look at the change in overnight policy rates from 335 end of last year, which was a reverse repo rate, today the effective rate will be 4.5, 465, 470. And effective rates from a rate hiking perspective, almost like 175 basis. So you should expect a bit more surprises, up or down, whichever way. But this RBI is not averse to surprising the markets or shocking the markets if need be. So you should, investors should be, cognizant of that and expect, depending on how data changes and situations evolve.
So RBI sees the FY23 CPI inflation at 6.7%. How do you view this 100-point increase in inflation projection?
Again, I'll go back to the Fed policies, pegging, even at that time, before the Russia-Ukraine war, pegging something at below 5% was their target. I don't know where they, how they got their numbers. And they've seen it's been a significant increase since, because we had seen increase in commodity prices in 2021 itself. India also saw an increase in CPI inflation, right? This is not the numbers that we are seeing now is not new. We've seen an increase in CPI inflation. Today we have an issue with food also. Although India is a large producer of many staple commodities of food, but we are seeing an increase. Global prices are feeding through into the Indian market very quickly. So if I look at our target for 6.7, maybe given where situation is right now, oil prices at above $120 per barrel. Global food prices, although they've corrected a bit, but hasn't corrected much. It might be higher than their projection. What is important for the market is 1 year out inflation. So when you come to the August and October monetary policy, you would expect the RBI to talk about October 2023 and March 2024 inflation, because the monetary policy works with a lag, right? So what they do now will impact 6 to 9 months later. So what they do in October this year will impact future inflation. So if they believe that rate hikes will have an impact on this supply side inflation, what is the trajectory then will matter. The other problem that we see for inflation is second order price hikes. So we've seen the first order of price hikes: oil prices, gas prices, food prices are flowing through. But how the households will behave in terms of their inflation outlook, and how corporates and intermediaries behave in terms of how much they are able to pass through now and how much they will pass through later, there will be significant amount of second order impact on inflation. So if in the next 3-4 months, there is a, say, a ceasefire in Russia, Ukraine, and there's some kind of, uh, agreement between them to kind of cease the war, you should expect some commodity price fall, some supply side responses. In that case, even though second order impact will happen, but it will be limited, and you might see reduction in the inflation. But if oil remains at 120 to 150 barrel, which is what the new forecasts are coming out from global commodity houses, that will be a problematic situation. It will require a larger sacrifice by the government in terms of cutting taxes and reducing prices, and it might require a higher interest rate from the RBI to be able to manage inflation, because today the inflation is still supply side. We still don't see very large pockets of demand inflation. Unemployment is reasonably high, incomes have been lost. We don't see labor price pressures in rural, agricultural, construction, and informal labor force. There is wage increase in IT, in finance, but not as much in the larger sections of the economy. So it's not a demand inflation, it is a supply led inflation. And government responses and global responses will matter more than RBI rate hikes. But as of now, as things stand, you should expect upside surprises to that 6.7% number. And hope and pray that global commodity prices kind of ease, because everybody gets hurt. This is not only India problem, it's a global problem. Everybody is getting impacted because of continuous supply side shocks, and the world requires some softening of commodity prices to sustain the growth momentum.
Was there any other notable point in the RBI policy announcement that you think retail investors who invest in debt mutual funds should be aware of?
What we've been saying since last year, that the return potential for debt funds and liquid funds and money market funds will get better as the RBI increases interest rates. As you're saying, that the best way to play that rate hacking cycle is to be in a liquid fund. Last year in early 2021, mid 2021, the difference between a bank savings rate at 3.5% and a liquid fund was almost nothing. So you could just leave your money in a savings account, and of course inflation would have resulted in negative returns. But if you are a risk averse investor or just surplus cash, you could have just left it there and not even bother about liquid fund. But that has changed. Bank savings accounts will remain at 3.5% depending on most banks, whereas rates on liquid funds, or what you call ultra short-term funds and money market funds, will increase as the RBI rate hike. So if the RBI repo rate is at 4.9%, the 3-month treasury bill should be above 5%. The overnight, what we call the overnight TREPS market, will be between 465 and 490. So that is the kind of returns that the liquid fund will try and generate, because that is the segment of the market that a liquid fund invests. The money market funds will invest in 1-year treasury bill. So of course there will be some mark-to-market losses as 1-year treasury bill rate goes up, but it's already closer to about 6%. So your savings account is at 3.5%. Your liquid fund was at 3.5%, has increased to about 4.5%, 5%. And your 1-year money market rates are between 5 and 6%. So from a relative alternative perspective, the return potential from liquid funds, money market funds, debt funds have gotten better. And it's always as compared to something, as compared to your fixed deposits, where you've not seen a large increase in fixed deposit rates, but you've already seen an increase in money market funds and debt funds. So I think that will get better, because this is an RBI where it's very clear that they're going to hike rates further. Right? You should expect, if they are forecasting 6.7% inflation for March 2023 and say 6% inflation going forward because of base effects and all for FY24 or below that, you should expect the repo rate to be somewhere closer to that level. So between say 5.5% to 6% by sometime in the next year, right? Which would mean that the returns from a liquid fund also will kind of follow that. So if you're a saver in a liquid fund, you're much better off. If you're a saver in a fixed deposit also, you're much better off because the interest rates are better. It is still negative in real rate perspective, but it is not as negative as it is.
So broadly, what will be the impact on debt mutual funds? Which categories should retail investors bet on, and at what level should they look to enter longer duration funds?
The potential returns that a new investor and a new allocation will make in any fixed income instrument, be it a liquid fund or a short-term fund or even a fixed deposit or long-term funds, will potentially increase in the course of the time. So the best way to play the rate hiking cycle is through liquid funds. As the RBI increases interest rates and takes out liquidity, the liquid fund which invests in 91-day maturity, which means very low market risk, and it has the best ability to reprice. Right? So as rates will increase, the yield or the return on the liquid fund will also commensurately keep increasing as the market goes up. So that remains the best way to play the rate hiking cycle. Which is why for the last 1 year we've been recommending that do not lock in your FDs. When we said lock in, do not invest longer term FDs last year. At low interest rate, there is no point in locking that rate for say 3-4 years and remain in cash. So of course last year returns were low, but as the rate hikes will begin and will happen, your yield on your surplus cash, which you typically leave in a savings account, will increase. So investors can choose between liquid funds. Some will choose ultra short term, some will choose money market. Now, as you go higher in the maturity profile, the maturity risk, the mark-to-market risk kind of increases, but it won't be that high. So, liquid funds to money market funds, there'll be some amount of mark-to-market risk, and money market for short-term funds will be slightly higher mark-to-market risk. And of course, long-term funds have even higher mark-to-market risks. So if you're very risk averse, and if you're using your fixed income as purely for surplus cash or emergency corpus, or as a diversification away from equities, you may choose to leave it in liquid funds, and your yield and returns will progressively increase over the course of the year. But sometime at the start of this year or late last year, we did also give a recommendation that over the course of this year, over the course of next 1 year, investors should also look at allocating from their fixed income allocation into medium to long tenor funds. In that, we recommended dynamic bond funds because that in that the fund manager has the flexibility to manage different outcomes. And the reason we said that was, if you look at the long-term average interest rate, so if I look at the 10-year or 20-year average of the 10-year bond yield or the 5-year government bond yield, it will be between 7 and 7.5%. And we're already there. The 10-year bond yield is at 7.5%. The 5-year bond yield is between 7.15 and 7.30, semi-annualized. So in a scenario where GDP growth is still well below potential, long-term interest rates are already at average, at its long-term averages. Relevant reasons: inflation, oil prices, global monetary policy, and demand supply. Fiscal deficit is higher, government is supplying more bonds, and the market is rightfully asking for a higher yield. But in this, generally we've seen that when long-term interest rates go above 8%, when either the inflation is very, very high or growth is higher, growth is at 7.5%, 8% real GDP, which leads to inflation. And to counter that, the RBI increases interest rates above this 7.5% long-term range. So we do not see that kind of scenario where growth is going to be at 7.5%, 8%. Then growth is below potential and interest is already at a higher level. If there is some reduction in the global supply problems or a ceasefire in Russia, Ukraine, and hence commodity prices come down, supply side gets better, you should expect slightly lower inflation or inflation expectation than what it is currently. In that scenario, we think that there is some attractiveness in the medium to longer term segment. But investors have to understand that you should have a 2 to 3 year horizon. Any allocation that you make to medium to longer tenor should be as an alternative to fixed deposits. So because fixed deposits are still not aligned, have not increased, but market bond yields have increased and it is giving you the opportunity. And you should make it over a period of time. So take a year's time. So put money in liquid funds, let the money, let liquid funds returns increase as commensurate with the normal rate hiking cycle. And you can maybe do a systematic transfer plan into medium to longer tenor bonds or dynamic bond funds with a 2 to 3 year horizon, knowing fully well that as rates go up, you will suffer mark to market losses and your returns could be lower than fixed deposits or sometimes even negative for a short period of time. But given that rates are already at long-term averages, this becomes attractive. Some people who have very high allocation to equities, not many have, but say if you are very, very high allocated to equities and you made your money and you invested in the right time and you're sitting on profit, may also think of doing this where they can cut down some of their equity allocation and move to medium to longer tenor bonds. So it is an opportunity. Rates are already higher and reflecting most of the risks that are in the markets. And if you have a 2 to 3 year horizon and as an alternative to your fixed deposit allocation, maybe you can look at some allocations to say a dynamic bond fund over the course of this year.
Thank you, Mr. Chari, for speaking to Business Standard. I'm sure our viewers will benefit immensely from this interaction. Thank you very much.